Hi guys, welcome to the third video on Simply Invest. I'm YJ and today, I am analyzing Amazon stock which is listed in NASDAQ. I will be evaluating the stock by looking at 7 factors and will provide you my own opinion and summary of the stock at the end of the video. I hope you learned something from this video. This is my own opinion and valuation method. You may or may not necessarily agree with my views and assumptions that I make in this video, but I hope you learn a thing or two on how to evaluate a stock. A stock value in the future is based mostly on the company's earnings growth, which is unpredictable. Everyone will have different assumption of how fast a company can grow, therefore I do not expect your assumptions to be the same as mine. But I hope your assumptions are logical, and you do not overpay for growth as this may lead to excessive loss in the stock market. If you are not familiar with the 7 factors that I use, I suggest you go view my tutorial video first. The link will be in the video description below. With that said, let's move on to the first factor. I will be evaluating the current asset and current liabilities of Amazon. I will extract most of the data I use from Yahoo Finance for all my videos, as I want to show my viewers that you can also evaluate stock without the use of any special applications. Looking at the current asset and current liabilities, the current asset is more than the current liabilities. This means that the company is unlikely to meet with any financial crisis within 1 year. Even after deducting the $11.8 billion revaluation gain on share price of Rivian, their current asset is still higher than current liability. So, for this factor I will give it a tick, which means it is a positive factor. The reason why I do not usually consider revaluation of investment as part of asset is because most companies do not have the intention to sell their investment. This is especially true for Amazon, as I would assume that they do not intend to sell Rivian. The second factor I look at is return on invested capital. I will take the net income after tax and divide it by invested capital. I will get a return on invested capital of 11.5%. I will also give this factor a passing mark because a return on invested capital of more than 9% usually means that the company is using their equity and liabilities to generate income efficiently. Moving on to the third factor, price to free cash flow. The price to free cash flow is 142, if I use the average free cash flow of the recent 3 years to calculate it. This means that the company could give you a 0.7% dividend now if they are debt-free. But I want to remind you that they are not debt-free now. The reason why I use the average of 3 years of free cash flow in my calculation, rather than the free cash flow in the most recent financial year, is because the free cash flow is affected by the movement of accounts receivables and payables. An increase of accounts receivables will decrease the cash flow, and a decrease of receivables will increase the cash flow. This accounting concept is hard to grasp. Usually, you would think that the more account receivables, the better the cash flow will be. But it is actually the opposite. The more account receivables you have, the worse your cash flow will be, as you would not have collected those cash. If you do not understand it, it is fine. I suggest to just take the average cash flow of the recent 3 years to minimize the error caused by movement in accounts receivables and payables. You would have noticed by now that Amazon has negative cash flow in year 2021 due to their increase in capital expenditure. In other words, they are spending more on maintaining property, plant and equipment and buying new ones. You can see this information if you go to the Amazon's financial statement to see the movement in their property and equipment from year 2020 to 2021. For your convenience, I have extracted the property and plant disclosure for you to see. There is an increase of 24 billion, 31 billion and 10 billion in land and buildings, equipment and construction in progress respectively, from year 2020 to 2021. I could not find any reason after doing a quick search online on why they increased their capital expenditure so drastically. Sorry for that. Now, I will assume that the stock will trade a price to free cash flow of 20 in 5 years' time. And that the company will have a capital expenditure of 20 billion every year. Honestly, I feel uncomfortable for using 20 billion as my capital expenditure assumption, as they have spent 40 billion in year 2020, and 60 billion in year 2021. The reason why I use price to free cash flow of 20 in 5 years' time is because, for all my investment I expect a future dividend of at least 5%. And this translates to price to free cash flow of 20. Anyways, with these assumptions, I'll work backwards to find out that the operating cash flow will need to be $98 billion for Amazon shares to be valued at price to free cash flow of 20 in 5 years' time at today's stock price or market cap. You can pause this video for a while if you want to see how I work towards these numbers. This would translates to a 115% growth from the current operating cash flow. This similarly translates to a growth of 16% compounding annual growth over 5 years. Only then will it justify the price to free cash flow of 20. This means if you want to earn a profit from the stock price appreciation, the growth of operating profit will need to be more than 16% over the next 5 years. In my opinion, an assumption of growth of more than 16% annually for next 5 years is quite a high risk. In summary, after evaluating this factor, I found out that a 16% growth over 5 years has already been priced into the stock. And since 16% growth over 5 years has been priced into the stock, you will earn a profit on the increase in stock price only if the company grows its profit by more than 16% over the next 5 years. Only after 115% growth in operating profit will you be able to receive a potential 5% dividend. This is given the assumption that the future price to earnings ratio is 20. And I think 20 is a reasonable number as it translates to 5% dividend or less. Honestly, I think 5% dividend is quite low. For all stock that I buy, I will expect a future dividend of around 8 to 10% based on the current stock price I buy. If you assume a future price to free cash flow of higher than 20, I would suggest that you buy a stock that can give you a 5% dividend today. So, I will have to give this factor a cross mark. And honestly, this factor is bad enough for me to not look any further. But for educational and informational purpose and for my viewers, I shall continue evaluating Amazon stock. I will have 4 more factors to evaluate. Moving on, we will look at the non-current asset and non-current liabilities to ensure that the company will be financially stable for the long run. The data is extracted from the financial statement of year ended 2021. Firstly, we'll be looking at the non-current asset. This includes property and equipment, operating leases, goodwill and other asset. I can safely assume that the company will not be selling any of these to offset its liabilities. These assets are most likely needed for continued operations. We will then move on to the non-current liabilities below. These are liabilities that the company will have to pay over time. I used the total amount of liabilities divided by my 3-year average free cash flow, and found out that the company will take 12.8 years to repay all its debt. I will assume that lease liabilities period are more than 10 years, as they usually are. I do not have an issue with the company's ability to pay off the lease. I am more concerned about the long-term debt. Therefore, I will look at the notes relating to the long-term debt. From here, you will notice that the average remaining life of debt is 15 years, which means Amazon will be able to repay them on time as we previously calculated, that Amazon will take around 13 years to repay all the debt fully according to its free cash flow. Moving on to the next factor, growth. I usually use the formula you see on screen to calculate the implied growth that is currently priced into the stock. If you want to know more about how to calculate it, refer to my tutorial video. Link is in the video description below. With the formula, I came to the conclusion that 18.73% of growth per annum for the next 5 years has already been priced into the stock. Then we will look at the earnings of Amazon in year 2021. The earnings of Amazon is $21,564 billion, after deducting the gain on revaluation of investment in Rivian. The reason why I do not take into consideration the revaluation into the earnings, is because it is an unrealized earning. The earnings will only be realized when Amazon decides to sell their shares, which I doubt they will. From my calculation that you can see on screen, Amazon had a great earnings growth of 84% from year 2019 to 2020. However, their adjusted earnings growth in year 2021 is only 1%. It is very risky to assume that Amazon can continue to grow at a rate of 18.73% compounding for the next 5 years. If I intend to earn a profit from the current stock price, the company must grow its profit by more than 18% per year. 18% growth will only justify the current stock price and not give me a profit. To give you more information on what is happening to the company, I have extracted the revenue growth of the company. From the illustration on the screen, you can actually see that Amazon has an amazing growth in their revenue in 2021. The growth this year is 22%. However, their earnings growth is only 1%. This means that their cost has also increased significantly, and the company profit margin has reduced as compared to year 2020. I would assume that there is some issue with the cost management, or inflation that the company is facing. Therefore, the growth factor is not looking very good for me right now. Moving on to the next factor, issuance of share. Amazon has been issuing 1% more of their shares for the last 3 years. And generally, issuance of shares is not good for shareholders as it dilutes their earnings per share. However, if the cash generated from the issuance share is able to stimulate more growth and offset the dilution of earnings, it may be a good thing for shareholders. And indeed, Amazon had been able to utilize their cash generated from share issuance to propel the company's growth as we had seen from the 84% growth. Therefore, I will not state specifically whether the issuance of share for Amazon is good or bad in this case. Moving on to the last factor, price to earnings ratio. I will combine all the assumptions that I make previously, such as growth, issuance of share, and the future PE of the company to compute my estimated gain or loss, if I were to buy the Amazon stock at today's share price. First, I will compute the current PE to give me a general idea of the current valuation. The current valuation is PE of 72, after adjusting the earnings by deducting the gain and revaluation of Rivian Automotive. I consider this PE as high, as I have previously computed that a 18% earnings growth per annum has already been priced into the stock. And the 18% is before I adjusted the earnings for gain and revaluation of Rivian Automotive. I will now create a simple illustration to show you the estimated future price of the stock based on different growth assumption. I will compute the compounded growth over 5 years in column 3. With the compounded growth, I can compute the earnings per share of the stock in 5 years in column 4. I will then assume that Amazon will issue 1% share every year. So I will calculate the diluted earnings per share in column 5. And with this I will be able to compute the stock price Amazon will trade at in 5 years' time, assuming that Amazon will trade at the PE of 20 in 5 years' time. You will be able to see in the last column, the gain or loss I would have made if I were to buy the stock at today's price of $3,065. With this information I have provided you, I hope that you have learned something about investing. You do not necessarily have to follow my assumptions, you can input your own assumption in your financial model. However, I'm always in the opinion that the future PE of a stock should be 20, because I use 5% dividend as my benchmark. Also, I do not make assumptions for more than 5 years because many things can happen in 5 years' time. To conclude the video, I would actually recommend those that are holding on to Amazon stock to trim their position. And those who are not invested to not invest in it. I admit that Amazon is a good company. However, you have most probably missed the opportunity to buy the stock at a good valuation. In life, when you miss a boat, you do not swim after it. You will get hurt. You wait for the next boat or you wait for the boat to come back. The same concept works in the stock market. You find another stock or you wait for the price to fall to a valuation that you are comfortable with. When looking at the 7 factors, when there is a tick on a few, it does not mean that you should buy the stock. It also does not necessarily mean you should not buy it. Instead, you should piece together the information and story that the 7 factors are trying to tell you, and make your own decision. A stock does not necessarily need to have all 7 positive factors to indicate a buy. If you like my video, leave a like and subscribe to my channel. You can also support me on Patreon. The Patreon link is in the video description below. You can support my channel contents and research with just $3 a month. And with $8 a month, less than 50 cents a day, you can have access to my Discord channel and ask me any questions there. I will also suggest one stock every month. This stock is exclusive to my Patreons in Discord. With just another extra $4 more, you will get a short report including a simple financial forecast from me regarding the suggested stock. The reason why I only suggest one stock a month is because I value quality over quantity. See you in my next video. Remember to invest safely and logically. Bye.